Hi everyone, welcome to this session of the CEBRA Inflation Drivers and Dynamics webinar series. My name is Pfajfar, and I'm one of the organizers of this webinar series on behalf of the Central Bank Research Association. Dominic Smith is the other co-organizer. And without much ado, let me pass on the virtual stage to Damjan Pfajfar, who is the Vice President in the Research Department at the Federal Reserve Bank of Cleveland and leads the bank's Center for Inflation Research and is today's moderator. Damjan?
Thank you very much, Raphael. So we have a busy program today. The two topics are the geospatial heterogeneity in inflation and complete pass-through in levels. Of course, special thanks to the organizer, Raphael Scholler from Brandeis University and CEBRA, and Dominic Smith from the US Bureau of Labor Statistics. Let me introduce the format first. The webinar is 45 minutes in total. We'll have two presentations of approximately 15 minutes each, and then 10 to 15 minutes for Q&A at the end. Attendees do not have the option to switch on their audio or video, but are invited to write comments or questions in the Q&A space. Attendees can, of course, pose their questions during the presentations already, and do not have to wait until the end. Then I will select a few questions to be answered in the Q&A portion of the webinar after presentations. The webinar is also live streamed via the CEBRA YouTube channel, recorded and made available on the CEBRA website and a CEBRA YouTube channel after the event. Links to the papers will also be available in the YouTube video descriptions if provided by the authors. Before we start, the disclaimer: participation in a CEBRA webinar does not constitute or imply an endorsement, recommendation, or favoring endorsement of the views, opinion, products, or services of the Central Bank Research Association or any other participating institution, individual, or entity. All views expressed during a CEBRA or a CEBRA co-hosted event are strictly those of the authors, discussants, and other participants, and not those of CEBRA, the co-sponsoring institutions, or any other participating institutions. Let me introduce the speakers. The first speaker is Seula. She's an assistant professor of economics at the Pennsylvania State University, and she will present the geospatial heterogeneity in inflation. And then the second speaker will be Kunal Sangani. Kunal is an assistant professor at the Northwestern University, and he will present complete pass-through in levels. Seula, you have 15 minutes.
Okay, thanks so much for the introduction. And then let me share my screen. Okay, so you can see the slides. Okay, yes. Perfect. All right, so thank you so much for having me. It's a great pleasure to present this work in this webinar. So this is work on the geospatial heterogeneity in inflation through the lens of retailer market concentration. This is joint work with Michael Navarrete at the Atlanta Fed. He might be joining this talk today too. So we have just the usual disclaimer from the Fed affiliation of Michael and the use of Nielsen IQ data in this paper. So we know that inflation is a key economic indicator for economic growth, stability, and household well-being. However, in practice, it is typically measured at the national level, which may mask important local variations. And understanding such local variations might be economically meaningful. If inflation varies a lot across different regions, then comparing nominal income might not translate into real purchasing power comparison properly. And if there is any systematic pattern of such inflation variations across regions having different income level, then it may also give us different implications to account for the real income inequality. So disregarding such regional variation in inflation may mislead welfare implications and effective policy design. And such features might be particularly salient for food inflation, given that food markets are highly localized and segmented, and also foods account for a disproportionately larger share of expenditure for low-income households. So following this, we'd like to answer two questions out of this paper. First, do inflation rates systematically vary across regions having different income level? And then if so, how would that be related to local retailer market structure and market power? To answer these questions in this paper, we use both empirical and theoretical analysis. Empirically, we use the Nielsen IQ dataset, which contains detail-level information for the retail chains in the US. And using that, we document the following stylized facts around the spatial heterogeneity in inflation and retailer market structure. In particular, we find that poor income areas experienced higher inflation than richer income areas over the period of 2006 through 2020. And then poor income areas also exhibit very different retailer market structure in which there exists a larger share of larger retailers and also higher market concentration. And then next, we try to identify the causal impact of heterogeneous retailer market structure on inflation. To do so, we exploit a bird flu episode as an exogenous cost shock to retailer pricing, and we've quantified the role of retailer market concentration in accounting for the regional variations in food inflation. And then lastly, we try to provide a mechanism by building a model of firms with endogenous markups and customer capital accumulation. And here we find that large firms in a very concentrated area can raise prices more aggressively by facing lower demand sensitivity and lower marginal value of retaining or attaining customer capital. So this can be a mechanism to account for this pattern, which is based on retailer market power and customer capital. Both are related to the retailer's market share. But for today's talk, given the limit of time, I will be mainly focusing on empirical analysis, but I'm very happy to chat about the other analysis that I'm missing to talk about today offline. All right, so first I'm going to talk about data and measures. So as I mentioned before, our main sample leverages this Nielsen IQ retail scanner data. Our sample covers from 2006 Q1 through 2020 Q3, and this data contains detailed information for retail chains across US markets, even along the set of goods that they are providing. And the big benefit out of this data is it contains very much disaggregated level of product code, which is named UPC. And for each UPC sold in each store owned by retail chain in the US, we can track the weekly pricing, quantity, volume, along with the store information that we can map into retail chains. And using this disaggregated level product code, we agree to product modules and groups. And at the end, we are focusing on 21 PCE food categories to be consistent with the official statistics. And also our main analysis is based on MSA level, and we map MSAs into income deciles based on the average income per capita provided by the BEA. And when I talk about large retailers throughout our analysis, this will be based on the top decile of the national level sales or store accounts. And in some of our analysis, we also check robustness using the Census Bureau's BDS data, although my main focus will be those results out of Nielsen IQ today. And then with that, we construct price indexes following the standard way. So we focus on the geometric loss variance index, and this price index is constructed at the MSA level for each of these 21 PCE food categories. And also, as for robustness check, we have used different types of price indexes, including demand-based, such as South-Korea. Also, we impose common good rules to our sampling, given the following reason. We know from the previous literature that consumption baskets vary a lot across different groups of people having different income level. And then this may also apply to regions having different income levels. And also we find the richest decile has substantially more UPCs than other deciles. So if we find any dispersion in price indices across regions, this may come from the differences in consumption baskets given this data evidence. So in order to rule that out and try to isolate the effect of retailers' market structure in accounting for variations in inflation or price indices, we impose a common good rules in our sample by limiting the sample to UPCs sold across all 10 deciles in a given quarter. And ultimately, we also, on top of that, apply common weights across these common goods. Okay, so with that, now let me talk about the set of main findings. The first thing is about spatial heterogeneity in inflation. And I'm showing you the price index for agri-foods across 3 income deciles constructed in Nielsen IQ, which are 3 solid lines here. The blue line captures the bottom decile, which is the poorest area. The green line is the medium decile, and orange line is the richest one. And you do see that food prices tend to be growing faster in poor income areas. And on top of that, we also plot the official stats provided by the PCE index, which is the red dashed line. And this is quite much on top of the richest decile. So this shows that national index is quite closer to the top decile, and that it might be representative for the richer group, but it may still understate the patterns we are finding in poor income areas, which are substantially different from this richer group. Also, we document that this is not mainly driven by differences in consumption baskets across regions, based on this common good rule that I mentioned in the left panel, and also applying the common weights on top of common good rules in the right panel. And also these patterns are robust across other food items at the more disaggregated level, and also for other types of price indexes that I mentioned before. Okay, and then the second fact is around the spatial heterogeneity in retailer market structure. So we are using the following MSA quarter level regression, where the mean outcome variable capture the retailer market structure at the MSA level, indicated by their total sales, the number of stores, chains, the share of large retailers, as well as market concentration within each MSA. And we regress them on the income per capita at the MSA level, along with adding the quarter fixed effects. And we do find that there are lower sales, fewer retailers, and also indeed fewer UPCs, although it is omitted from this table. But we also at the same find a higher share of larger retailers and also a higher market concentration in these lower income areas. So it seems like retailer market structure varies a lot across regions depending on income level. And then furthermore, we try to relate the inflation variations to the variations in income as well as this market structure in the following way. So we are using the following regression where the main outcome is the Las Vegas inflation rate for agri-food at the MSA level. And then we try to regress it on either the income per capita or market concentration at the MSA level. And we find that there exists higher inflation in highly concentrated and also lower income areas. This is consistent with the figure that I showed earlier. And then these results are also robust with other specifications using different set of controls and different measures to indicate market concentration. All right, so this shows that there seems to be spatial variations in inflation and retailer market structure depending on the regional income level, and it seems to be correlated to each other in a systematic way. However, nothing has been about causality yet, so we further try to identify the role of retailers' market concentration on accounting for inflation variations. In order to do so, we exploited the following episode as an exogenous cost shock to retailer pricing. So there was bird flu outbreak in late 2014, which caused substantial price spike in 2015 in the following quarters. And you can indicate this period quite easily from the following figure, which I am showing the Geospatial index for egg price. And then you see that there's a big spike across all regions and even in the national index around this period from late 2014 through 2015. And based on the government records, there seems to be substantial geospatial variations in the impact of this shock. So using this information, we implement the following triple definitive estimation. So we use the Las Vegas inflation rate for eggs at the MSA level again. And then we identify those MSAs impacted by the shock using the government records and indicate them using this variable name treated. And also we use another dummy indicating the post-treatment period and further interacting them with the MSA level market concentration measured by the HHI index. And we measured this at the quarter prior to the shock. And our main focus here would be this triple interaction term between these diff terms and the HHI index, which should capture differential responses of retailer price with respect to this cold shock, and how that vary across regions having different degrees of market concentration. And then our sample includes 2 years prior to the shock and 2 years after the shock, so it covers 2012 through 2016. And we further track the responses along different phases of the shock. So we decompose the sample into inflationary period and deflationary period, where inflationary period captures the period in which the national inflation for X is positive. So this will basically capture the period right after the shock, where the retail prices immediately respond to the shock. Okay, so the following table shows the results. And then we find that there is a positive coefficient associated with this triple interaction term using our pool sample. This indicates that the X price is rising after the shock, but amongst these impacted areas, this will be even more pronounced for those areas having higher market concentration. And we further disentangle this into 2 periods that I mentioned. So the second period captures the 3 quarters right after the shock, which is basically inflationary period. And then we do see that this pattern is more pronounced in this period where pricing gets even higher in these impacted areas having higher market concentration. But another interesting fact we found here is the last column, which is the deflationary period after the shock fans out. So after a while, the shock fans out and the price are supposed to be reverting back. But indeed, in these markets having higher market concentration, that was not the case, and there seems to be asymmetry responses across regions having different degrees of market concentration. And indeed, these regions having higher market concentration still have some persistent effect out of this bird flu, although the shock itself was temporary. We also confirm robustness of these results by using different specification and also different measures. So for example, we use HHI terciles instead of using continuous variable in order to understand further nonlinearity going on there. And we do find that this effect is mostly driven by the very highest tercile group. And also the results were robust across different concentration measures, and even after including some neighboring treated MSAs. And also we indeed adopt another shock to run this regression. So we follow one of the paper by Kunal Sangani, who is another presenter today, and use coffee commodity price changes as another, cold shock, exogenous cold shock, and confirm this result in a consistent way. And lastly, we have also ruled out some alternative hypotheses that could explain these results, either through consumption basket composition varying across regions or retailer composition varying across regions. And also there might be other sources of cost that can create different responses of prices. We have ruled them out with further analysis. Okay, and then lastly, before I wrap up, I wanted to quickly add that in order to further account for mechanism beyond this market concentration, as I mentioned earlier at the beginning, we had a model having firms charging different markups and accumulating their customer capital. And then there we also find that firms having very large share in a highly concentrated markets tend to have higher pass-through of cost shocks on their pricing because they face less sensitivity of their demand function, as well as they have enough level of customer capital that they can leverage to charge higher pass-through. So in the theoretical model, we do find that this might be related to retailers' market power and also customer base. And then potentially we could test that if we find some good data to use. So let me wrap up based on these results. So in this paper, we find systematic differences in inflation rates and retailer market structure across different regions having different income level. In particular, we find that poor income areas face higher inflation rate and also higher concentration at the same time. And we try to relate that by using this causal experimentation exploiting the bird flu episode. And we find retailer market concentration seem to causally contribute to persistent differentials in inflation, and thus it can potentially impact real income inequality. And lastly, we provide a mechanism through retailers' market power and customer capital base that may vary across markets having different degrees of market concentration. And this can potentially amplify cost pass-through and also aggregate markup, which can give us important welfare implications. All right, so let me stop here. Thank you so much, and looking forward to further discussion later.
Thank you very much, Seula. We'll go right on to our next presenter, Kunal.
Awesome. Thank you. Thanks so much for having me. And it's a pleasure to present a very related paper alongside Seula. So I'm going to talk with you about pass-through today. I'm also going to present some Nielsen data. So, pass-through is an important statistic for a number of economic phenomena because it determines the incidence of upstream shocks like exchange rate movements or supply shocks or taxes and tariffs on downstream producers and consumers. And for that reason, there's been a lot of work studying the extent of pass-through. And the empirical fact that emerges throughout that literature is what I'm going to refer to as incomplete long-run pass-through. So if marginal costs rise 10%, say the price of coffee beans or producing coffee rises 10%, studies find that the price of downstream products like retail ground coffee that you buy at the grocery store increases by less than that. It increases by 3 or 4%. And that pass-through is incomplete even at long horizons at which nominal rigidities should be overcome. And it's incomplete even relative to the cost share of that input, say coffee beans, in the variable costs of those producers. And so that's motivated a lot of work in macro and trade that tries to develop flexible models in which the extent of pass-through can depend on different market characteristics like market concentration or the shape of consumer preferences. Today, I'm going to revisit this stylized fact about incomplete long-run pass-through, but I'm going to measure pass-through in a slightly different way. Rather than measure the pass-through in percentage terms, I'm going to measure the pass-through on a dollar and cents basis. And what I'll find is that incomplete pass-through in percentage terms often disguises complete pass-through in levels. So if the price of an input, say the price of coffee beans, increases 10 cents per ounce, then it turns out that downstream prices of coffee you buy at the grocery store tend to increase by just about 10 cents per ounce. That pass-through in levels looks incomplete when it's measured in percentage terms, because if price is greater than cost, then the same dollar change in price and cost looks like a smaller percentage change in price relative to the percentage change in cost. Moreover, I'll show you that not only does complete pass-through explain why we see this incomplete pass-through when measured in percentage terms, but it actually explains the cross-sectional variation that we see in this percentage pass-through across products or firms in a market. Firms that have a larger gap between price and cost look like they have lower pass-through in percentage terms, when in fact they just have the same pass-through in levels as other firms. I'm going to show you mostly some graphs from food products today to give you a flavor of this evidence, but the same pattern spans many markets, as I try to argue in the paper. So let me just fix ideas with a simple example. What I want you to have in the back of your mind as I go through the empirics today is a firm that uses some commodity input in production, potentially alongside other components of marginal cost. So say we have a firm that has $1 of commodity costs and they have $1 of other components of marginal cost. So their total marginal cost is $2. And let's say initially they have a markup of 2, so they set an output price of $4. Our question is going to be what happens when the price of this commodity increases. Now, a lot of macro and trade models predict that firms will exhibit complete pass-through in percentage terms in the long run. So they'll have a fixed percentage markup over marginal costs. And if that's the case, that means that they should increase their price by the same percentage amount as marginal costs. In this example, that means that they should raise their price by 40 cents. And of course, that means that the pass-through in levels would be 40 cents over 20 cents, or 2, exactly equal to the firm's gross markup. What I'm going to argue we instead find in the data is that firms appear to pass through the cost shock 1-for-1 in levels. Of course, that 20-cent increase in the price now looks incomplete in percentage terms relative to the percentage change in marginal cost. So to look at this, I'm going to first look at some food products. Here I'm going to use data from the BLS Average Price Data Program. It's a data program that, in addition to their CPI program, tracks price levels for a bunch of staple products that are purchased by consumers. And for 6 of those products, like roasted ground coffee or granulated sugar or flour, we can match the products pretty carefully against some commodity input that forms a large share of the marginal cost of producing that product. So here's coffee again as an example. The blue line here is the retail price of roasted ground coffee tracked by the BLS. And the orange line here is the commodity price for Arabica coffee beans, normalized to have the same units as ounces of coffee that you buy at the grocery store. And you can see that there's systematic fluctuations in the commodity price. These are mostly coming from weather shocks in Brazil and Colombia over this period. And you can see that the retail price is responding fairly immediately to those fluctuations in cost. So to measure the extent to which these cost fluctuations are being passed through to downstream prices, I'm going to use a canonical specification from the exchange rate literature, this distributed lag regression. And you can show under certain conditions which seem to be satisfied in this setting that this regression, the accumulation of these coefficients BK on lags of changes in the commodity cost, the accumulation of those will deliver the long run pass through of change in the commodity cost to the downstream price. And so here's what that looks like for coffee. The top panel is showing you the pass through in levels, and you can see that the retail price, responds with somewhat of a delay, but by 6 months, the pass through in levels of a commodity cost change to the retail price is indistinguishable from 1, and it hovers right around there thereafter, and you can extend this plot out further and you'd see it staying right around 1. So it looks like complete pass-through levels of these commodity cost changes to prices. That mechanically means that the pass-through measured in percentage terms is going to look incomplete. And so if you run this specification in logs, which is shown in the bottom panel, you of course get this incomplete pass-through at a rate of about 30 or 40%. Okay, well, maybe this is just a coincidence for coffee. Maybe it happens to be the degree of markup adjustment just so happens to coincide with complete pass-through levels. Well, now we can do this for each of those 6 products that I mentioned from the BLS data. And remarkably, what we find is across these products that have different market concentration, different consumer preferences, we tend to find what looks like complete pass-through levels for almost all of these products. In fact, the one exception here is sugar, which seems to have slightly lower than pass-through levels. But actually, if you extend the sugar sample back further using data from the USDA to capture more cost variation, you get something that looks remarkably like complete pass-through levels again. Now, these are time series estimates, and so there's you can see that there's some noise just coming from the estimation here, and it would be hard to reject low but fixed percentage markups that might be plausible in the setting. But we can do better here. We can actually exploit the cross-sectional variation across products in these markets. And so I'm going to do that now using the same kind of Nielsen scanner data that Seula used. And so here I'm showing you rice as an example. Rice is a great example here because there was this pronounced shock to rice commodity prices in 2008, the global rice crisis, when India and Vietnam imposed export restrictions on rice. And so you can see that inflation, that rapid inflation and deflation in rice commodity prices in 2008 in the dotted line. And then the 3 solid lines here are showing the reaction of inflation for rice products at the grocery store in response to this commodity cost shock. And you can see that the percentage pass-through of this cost shock very dramatically across different rice products. In particular, the lowest unit price rice products, the cheapest products, exhibited a very high pass-through in percentage terms of the same commodity cost shock, while the high unit price expensive rice products exhibited little response. But now if you do the same exercise, instead looking at the price changes in dollars and cents, you see a very different story. Actually, the differences across these products largely disappear when looking at the pass-through in levels. And so the simple story here is that the same dollar change, the same dollar increase in prices for the expensive versus cheap rice products looks like a much higher pass-through in percentage terms for the products that have a smaller gap between price and cost. And it turns out this systematically occurs across these categories. So if you look at coffee or rice or flour, in each of these cases, fluctuations in commodity cost always result in lower percentage pass-through for the higher unit price products. But when you look at the pass-through in levels, those differences largely disappear. Okay, so I've tried to give you a flavor of what looks like this complete pass-through in levels across different food products. In the paper, I go into a lot more detail looking at a bunch of other industries like retail gasoline, um, and then actually looking at the entire US manufacturing sector. Across these different environments and in previous work, it looks like the statistic emerges repeatedly, which is that if you look at the pass-through in levels of these common input cost shocks to an industry, you repeatedly find what looks like complete pass-through in levels. Now, let me briefly comment on why, from a theoretical perspective, this is a challenge relative to the workhorse models that we tend to use in macro and trade. The easiest example here is CES demand, which many of you are familiar with. In CES demand, firms want to charge a fixed percentage markup times marginal cost. And so if their costs increase by 10 cents, they want to increase their prices by 10 cents times their fixed percentage markup. It turns out that's not just the case for CES demand, but it's actually true for any homothetic industry demand system if all firms are exposed to an industry-wide cost shock. So many of the demand systems like Kimball, nested CES, HSA demand that are designed to accommodate incomplete pass-through of idiosyncratic cost shocks to firms still would actually predict complete pass-through in logs or in percentage terms of a uniform cost shock that affects all firms. Now, it turns out that there's an alternative class of demand systems that would instead be consistent with our evidence. And I call those demand systems ones that satisfy this property called shift invariance rather than the scale invariance that most of our demand systems use. And actually, they're not very exotic demand systems. So actually, many of the demand systems in the IO literature, like Logit, BLP, or spatial models like the Hotelling or Salet model, would be able to explain our evidence of complete pass-through in levels of these industry-wide cost shocks. Now, let me take my final couple of minutes to tell you why this pass-through in levels matters for macro. And I'm going to argue that pass-through in levels matters for measuring pass-through, for modeling pass-through, and then for understanding some recent price dynamics during the post-COVID inflation. So first on measuring pass-through, well, if pass-through is complete in levels, measuring pass-through in percentage terms can introduce asymmetry and size dependence into pass-through just coming from the functional form that's being used to measure pass-through. So for instance, pass-through in levels would predict that log pass-through is going to look greater for cost increases than for cost decreases. You're going to get this asymmetry in pass-through. And pass-through in levels is also going to imply that log pass-through is going to look greater for large cost increases relative to small cost increases. We also saw some of the pattern in heterogeneity already when looking at rice products, but mechanically, if a firm has a higher markup, so a higher gap between price and cost, that's going to result in the firm having lower log pass-through. So if you think markups tend to increase with firm size or with product quality, well, then you're mechanically going to get lower log pass-through for large firms or high-quality products, consistent with what people have documented previously. Second, on modeling pass-through, increasingly in macro and trade, we're using input-output models with rich models of the supply-side economy, multiple different industries, and input-output linkages to study the effects of shocks and policies. And I would argue that the predictions of these models hinge critically on how you assume cost shocks are being passed through along supply chains. And so let me just give you an example of that using a shock to the oil price. So this is a shock identified by my colleague Diego Kanzig using OPEC announcements for shocks to the oil price. And you can see the shock to the oil price in the left-hand side. I'm going to feed that oil price shock into sort of canonical input-output models of the economy. And intuitively, the models with fixed percentage markups predict much too much responsiveness relative to the empirical results. Because these percentage markups are amplifying the cost shock as we move downstream through the network. In contrast, if you use a model with additive markups, and so you have pass-through levels, you're going to actually match the data remarkably well. And then finally, let me take my last minute to talk about how pass-through levels can inform these patterns around cheapflation and inflation inequality. So one simple observation is that if firms increase their price by the same amount in levels following a cost shock, that's going to look like higher inflation for low-priced varieties when commodity input costs rise. And since low-income households disproportionately consume those lower-priced varieties, their inflation rates will increase relative to high-income households when commodity costs rise and decrease relative to high-income households when commodity costs fall. And you can see that pretty remarkably, I think, here when you look at coffee prices. So the dotted line here is the movements in the coffee commodity price. And then the blue line here is the difference in inflation for coffee faced by the lowest income quintile versus the highest income quintile. And you can see exactly this pattern take place. This is actually true if you look across the entire food at home bundle, not just at specific categories like coffee. And so, here was this dramatic cheapflation that we saw during the post-pandemic period, where lower priced varieties within categories saw much higher inflation than higher priced varieties. But it turns out that's not an anomaly about the post-COVID period. You see that every time in the time series when input costs for food rise relative to the aggregate price level. And it turns out if you just play through the predictions of pass-through levels through what you should expect for differences in inflation for food at home across high and low income households, you get remarkably close to matching the fluctuations in inflation inequality that we see in the data for households over time. And so the blue line here is the data on inflation inequality from quarter to quarter across low versus high income households. The black line is what you'd get just from pass-through levels. It actually turns out, during the post-COVID period, there was a lot of discussion about whether price gouging by retailers or excess demand from the distribution of stimulus checks was causing cheapflation and higher inflation inequality at the low end. It turns out that just pass-through levels is enough to buy you the extent of cheapflation and inflation inequality that we saw during that period. And if anything, the extent that we saw during that period was maybe relatively muted relative to what we should have expected. Okay, so that's a quick summary of why pass-through measured in percentage terms, which often comes up as incomplete, might often disguise actually complete pass-through in levels. There's a lot more in the paper about how it can rationalize other sort of patterns in the data that would be substantially harder to explain with canonical models that instead predict complete log pass-through. So happy to talk about those or to refer you to the paper if interested.
Thank you very much, Kunal. Okay, so let's start with a question that's sort of, it's related to both of your papers. For example, Seula, you showed that the inflation is higher for the low-income people for food prices. But what about the price level? So was the starting price level the same when you do that, or there's just that lower income MSAs are catching up with the higher income MSAs? So can you tell us a little bit about that? And that obviously relates to Kunal, one of your final points that you were making. So you can comment on that as well.
Yeah, so I have not really talked about the level of prices, but indeed in our sample, we also find that the level of prices is lower in per income area, although we do see higher inflation on average in these areas. So it's more about the latter type of story where the level of prices might still be lower in these areas, but maybe through higher inflation, they are catching up. And then this pattern also holds even after controlling for the same set of UPCs. So even after looking at the same goods, the pricing level might still be lower in per income area, but a higher inflation is associated with it.
Maybe, Kunal, you discussed about the pass-through in different areas. Do you have any insights into heterogeneity between higher and lower income areas?
Yeah, so one thing I've been finding as I look at this data as well is high income areas seem to have higher retail markups at least. So if you try to measure the retail markups across different cities, solely measured as the gap between price and sort of cost of merchandise, so not accounting for rent and labor. It looks like there tends to be higher markups, retail markups in those high income cities. And so let me tell you where I think that could go in the direction of Seula's findings, but then where also I think Seula finds something that would be quite hard to explain with just that kind of basic model. And Seula can correct me if she disagrees. So one thing I think that would mean through the lens of pass-through levels is that if there is this larger gap between price and cost in high income areas, it would mean that these same common cost shocks would result in dampened inflation for high income areas. And that could come just kind of mechanically from these different gaps between prices and costs. And I think Seula showed very convincingly, though, that there's some asymmetry between the effect of cost increases during the avian flu epidemic, for instance, on prices in low-income areas or inflation in low-income areas versus the effect of cost decreases. And I think that would be significantly harder to explain just with pass-through levels. So I think there's compelling evidence there that something else is going on rather than just differences in the steady state gap between prices and costs.
Okay, maybe we continue with another question for Seula. So, is there, a difference in, like general merchandisers like Walmart and Target, how they cover these areas? Is there a heterogeneity there? If they're, for example, if they're not in your data, or if they are in your data, first question is whether they are or they're not in the data. And secondly, one could ask whether there is a selection of merchandisers that are in the poorer area and richer areas, and how does that sort of affect your results?
Yeah, that's a great question. So I believe we do have such mass merchandisers in our data set, and the coverage is pretty good, which gives the second highest following the grocery store. The thing we haven't looked into yet is how, the share of these different types of retailers, are located across different regions, and that could be something we can further look into. But one thing is these retailers are de-identified, so we cannot really, see which specific retailers are in our sample and how they are allocated across regions. But at least we could do this by the types of retailers, which we haven't done yet.
Yep. So one last question for you, or for this round is: are there any lessons that we can learn from your analysis for when we do sampling for the PCE respondents? Do you have any lessons that you can share with us?
Yeah, so one implication from our finding would be that maybe this official statistics should increase the number of, or increase the scope of areas sampled. So as I mentioned before, like based on my understanding, the BLS provides this MSA level price indexes, but these are really highly concentrated to a subset of regions which are mostly larger or richer. They typically exclude those poor MSAs area or less populated areas, which exhibit high heterogeneity in inflation and price dynamics, as I show in our Nielsen data. So maybe one implication could be the sampling could be broadened across disaggregated regions, and maybe enlarging the scope for the especially poor MSAs or less populated areas may give us different results out of the national index.
Thank you. A few questions for Kunal. Kunal, pass-through in levels seems like it would predict a declining markup as long-run inflation raises input costs. Do you have a sense how pass-through could differ for input shocks versus like a more moderate policy shocks or any other shocks that might hit the economy?
Yeah, this is actually a really key point, because all of the evidence that I showed and all of the evidence in the paper is about relative price shocks. It's about the price shock to one input, say the price of coffee beans or a commodity, holding other prices in the economy fixed. And so, I think you should not extrapolate from complete pass-through levels of these relative price shocks to how markups would change or not change if you had generalized inflation of the aggregate price level. And in fact, like the demand systems that I write that would rationalize pass-through levels of these industry-wide cost shocks would still predict neutrality with respect to a change in sort of the unit of account or anything like that. The paper goes a little further and tries to argue that actually these firms are charging additive markups. Those additive markups empirically seem to look like they're being set relative to the aggregate price level or relative to wages. And so it turns out that kind of empirical model does quite well in explaining the dynamics of prices in the manufacturing sector, for instance.
Very good. Then pass-through level seems like it. Sorry, I already asked this question. Have you looked at gauging importance of the Leontief assumption? How sensitive are model predictions to small deviations from Leontief production functions?
Yeah. So Raphael's exactly right, that everything that I showed you today kind of starts with this assumption that if the price of an input increases 10 cents, then firms' marginal costs also increase by 10 cents. And if firms can substitute, if they're not completely Leontief, then they can partially offset some of that cost increase. by substituting to alternatives that didn't face that cost increase. It turns out you can characterize how much of an attenuation you'd get coming from other production functions. And there's two things to note there. First, actually, to a first order, this elasticity of substitution doesn't matter in production. So actually, you need kind of large deviations for this to matter because it's all in the second order effects. And then the second thing you realize is also, in order to get this kind of pass-through levels across a bunch of different markets, you need quite knife-edge conditions around how exactly the elasticity of substitution would vary across these markets to deliver that prediction.
Thank you very much. I think we are at 11:45, so thank you for participating in this webinar.
Thank you so much.
Yeah, thank you,
Thank you, everyone.
Nice meeting
Thanks,
you
everybody.
guys.
So many questions. I have to do it again. Thank you. Bye.
Thank you. Bye.